Hello and welcome back to our Chapter 5 Short-Term Investments and Receivables lecture. We are picking up with Learning Objective 5, which is Accounting for Notes Receivables. So basically the main thing here is you need to know the terminology. So these are terms and then you should have these pretty much know and be able to answer them in an Excel type multiple choice question. So the creditor is who the money is owed to. The debtor is the party that borrows the money or the borrower, so make sure creditor equals lender and debtor equals borrower. Interest is basically the cost. It's usually an APR, annual percentage rate. You'll see that quite a bit. You're probably familiar with that with credit cards. Maturity date, the date when it has to be paid. Maturity value includes principal plus interest. Principal is the amount you borrowed, and terms is for how long you borrowed it. And it is classified as current or long-term. What is classified as current is the piece that is coming up within the next 12 months. So here is the principal amount, right? So we have here $1,000, right? And then we have it both in actual dollars and in verbiage. Then the interest period starts, and then basically it says you promise to pay on October 31st because that's when you got the note. Then the payee or the creditor in this case is Continental Bank. That's who you're paying. The maturity date is telling us on February 28, 2015. So we have a short amount of time here. The interest rate is telling you 9%, as you see here. So this is the maturity date. Then the maker of this note is maybe Lauren Holland. And so now we have the note. Now we need to know how to account for this note, right? So first, we consider the promissory note that we just looked at, and Lauren Holland signs the note, and Continental Bank gives her $1,000. So here you have notes receivable, and cash is being signed, so you have a credit balance to cash. So here the bank made a note. And so now this you should have in Excel, principal equals interest, which let's erase that one sec. Oops, let's erase that. So let's see. Sorry about that. Let's go ahead and get this done properly for you here. So interest equals principal times rate times time. So the interest amount is what we're looking for. So interest equals principal times rate times time, and usually time is divided by 12 for months, right? So this was at December 31st. So now we're going to take each of these amounts and add them. So we have principal is $1,000 at 0.09 or 9%, and 4 out of 12 months is what we're looking for, right? Because it tells you here we have September, October, November, and December, 4 out of 12, to get $30 interest. So that would be interest receivable of $30, and then you're making interest revenue of $30. So then on how do you account for it? So basically now on the bank's report, right, you have current assets, notes receivable, and the interest that is owed, and then this is what they made on their income statement. So now the bank collects the note on February 28th, and so they're getting now cash. So they're getting $1,045 because they're getting the original $1,000, and then they have their interest receivable that they already recorded, and now they're recording the additional 2 months because this was a 6-month note to get the additional $15 of interest. So the total amount, and then you're basically taking the interest receivable because this is what you recorded for the 4 out of 12, and then here is your 2 out of 12. So interest, as we mentioned, is expressed in either months or days, 365. You might also see interest used for 360 days as well. That happens also. So now we want to show our last learning objective, which is how to speed up. Actually, our second to last is this chapter has 7, how to speed up cash flows and receivables. So obviously sales discounts, right, 210 net 30 that we talked about, any interest on any past due amounts. You also want to make sure you have credit and collection procedures, and then you want to emphasize credit card and bank charges. So here, if we sell a computer and the customer pays with the Visa, there's a 2% fee. So here we're taking the $5,000 computer, multiplying it by 2% to get basically $100. So basically we're going to get the $4,900 because the Visa isn't going to give us the full $5,000 because they're going to take their fee out of it. So this is just common practice. American Express is probably the most notorious for charging. I would say 2 to 3% is about common for Visa and MasterCard. 3 to 5 is for American Express in my experience. And realize that the credit card company is not going to give you the full $5,000 and expect you to pay the fee to them. They're going to net it. And so that's why you need to know this entry. Now, when you're selling or factoring receivables, you might also do this because you get a discounted price. So in this case, what you have is if you want to speed it up, you take your 100,000 of receivables, but you're going to sell it for 95,000 cash, so that's going to go up. But then you're going to say you have a financing expense of 5,000 because you've got to take the receivables out. And then once you sell it, selling your receivables isn't a downright cash transaction. Pledging that for your loan, right? So if we pledge accounts receivable towards a loan, right, that is collateral. So that's different. They're still your receivables. You're just saying, hey, this is what I'm using as collateral for this loan. So now we are at our last learning objective for chapter 5, is that we're going to look at 2 liquidity ratios. And here I would say you should have a ratio tab in Excel with all of your different ratios that we've accumulated through the chapters. In this case, we're talking about a quick or acid test ratio where we have cash plus investments, short-term investments, plus net AR, accounts receivable, divided by our total current liabilities. And we call it a quick ratio because these are considered the most liquid of assets. Right, so that's why we're only using cash. We're not using inventory in here, we're using investment. So note, that's different from the current ratio that we've computed. So the higher this ratio, the better. So we want that number to be. And so here, and anything above a 1 is usually very good. Then we have these other ratios that you should have all in Excel as well. So, and these are more about receivables. These are commonly used, and I would highly recommend you put them in Excel with formulas. Here, this tells you your average number of days that your accounts receivable is in sales. Then here you have a days of sales in receivables, and then to get this amount here, you can use beginning balance plus ending balance divided by 2, or you can use the average formula in Excel as well. And so basically here we have some information about Arcadia Company, and you're going to use this information to get the amounts that you need. So now if we're doing the quick ratio, we have cash and cash equivalents, and that's going to be our 6,000 here. We have marketable securities, and we have net receivables, which it's already reported net, so we are pretty good here. And then our total current liabilities, right? They don't give us that total, but we know that these two are current because this one actually says long-term. So that's our 15 and our 107. And then once you get that quotient, you'll get 0.69, which is weak, right? Because we want it to be greater than 1 to show that our numerator is greater so we can pay our current liabilities that are coming due. Now, if we move to days sales and receivable, right, we'd have our net sales and then our 365. And if we come back here, we see our net sales right here of the 728. So that gives us that amount. And then for your average net receivables, we want to get that balance. So let's just go back 1 second and we see our beginning balance and our ending balance, 56,000 and 70,000. And then that's what we're adding here and dividing by 2. So this tells us that we have about 2,000 every day in sales, and our receivables, they stay that way for about 31.6 days. So if we're giving 30-day terms, we're pretty close, but that doesn't seem to be that many people are taking advantage of our maybe early payments. So this concludes our video lecture for chapter 5. Thank you.